Hello friends, my name is Kobe Hunter, and today we are going to answer the question of, will investing in ESG companies make you more money than non-ESG companies? Let's be honest, we all want to see the world become a better place. So, to encourage this, many people choose to invest in companies with similar causes or beliefs to their own. And the traditional narrative about these ESG investments is that people have to pay either a premium in either the stock price or the index expenses for the privilege of supporting these companies. But even if you're only concerned with profits and nothing else, ESG might be a good choice. Research from the Harvard Business School, McKinsey & Company, and the Kenan Institute outline that there could actually be a way to increase the likelihood of beating the market through investing in ESG principled companies. Now, if that sounds too good to be true, stick with me as we analyze if ESG investing is really all it's cracked up to be. This video will be broken down into 5 parts. First, what is ESG? Second, how is ESG determined? Third, will ESG companies outperform the market? Fourth, what stops companies from prioritizing ESG? And fifth, how you can use this information to make you more money. Before we start though, as you watch this video, I want you to think about if I deserve a subscription or not. I spend hours combing through academic research papers, consulting firm reports, and many different websites to consolidate an accurate and educational and hopefully entertaining video for you guys to watch. When you subscribe, it tells YouTube that this is a good video. So YouTube will show it to more people. And then in the future, you will get to see more videos like this one. I post one full-length video a week, but again, only subscribe if you feel like I deserve it. Thanks again for watching, and now let's get into the rest of the video. So what is ESG? You're probably thinking, Kobe, you keep using that phrase ESG. What does that even mean? Well, according to Investopedia, ESG stands for Environmental, Social, and Governance Criteria. These criteria are used by investors to screen potential companies and investments. So, for example, for the environmental part of ESG, characteristics may include things like corporate climate policies, energy use, waste, pollution, natural resource conservation, and treatment of animals. Choosing to invest in Tesla, for example, because you want to support electric vehicle proliferation is an example of the E part of ESG. Social could be things like employee compensation, diversity in the workplace, actions in regard to human rights, and workplace conditions. Choosing not to invest in a company that is known for the use of child labor is one example of the S part of ESG. And finally, issues in governance include executive pay, executive diversity, accounting transparency, and board independence. Choosing not to invest in Meta, also known as Facebook, because Mark Zuckerberg is the CEO and chairman of the board, which makes him essentially the king of Facebook, is an example of the G in ESG. ESG investors and ESG funds can prioritize one of these categories or all 3 of them. ESG investors also can pick and choose which environmental, social, and governance factors they really care about. But in general, ESG investors want to ensure that the companies they invest in are responsible stewards of the environment, good corporate citizens, and are led by accountable managers. How is ESG determined? ESG is a general principle or guide map. It's not a standard. There are many different groups that all place their own ESG ratings on companies. I'll list them, but it kind of sounds like alphabet soup. You've got Robeco, Sustainalytics, Video Iris, MSCI, GRESB, CDP, UNPRI, SASB, GRI, TCFD, and SAM, all with their own different criteria, frameworks, data collection methods, and priorities. Not all companies claiming to adhere to ESG principles are created equally. Just because you see a company that has ESG on their website or are in an ESG index fund does not mean that they are perfectly sustainable or hold all your values. For example, according to the Wall Street Journal, BlackRock says its iShares ESG MSCI USA ETF aims to track an index of companies with positive environmental, social, and governance characteristics. But the fund includes ExxonMobil, which is currently awaiting a ruling in a trial involving allegations that it misled investors about how it accounted for climate change regulations. And another example is Vanguard Group's FTSE Social Index Fund is meant to track an index excluding companies with significant controversies regarding environmental pollution or severe damage to ecosystems. But that fund includes Occidental Petroleum, which in 2015 paid Peruvian indigenous villagers an undisclosed sum to settle a lawsuit accusing it of contaminating the Amazon. So, as you can see, just because they are in an ESG fund doesn't mean that they are sinless. But to be fair to BlackRock, The Wall Street Journal also reported that a BlackRock spokesperson said that the firm designed its sustainable funds to offer investors the highest ESG-rated companies in each sector. So, depending on where you stand, investing in the most environmentally or socially conscious business in a traditionally non-conscious industry could be a good way to encourage other laggards to change their ways. But you could also see this as a waste of capital and prefer to invest it in more sustainable companies, like in this case, supporting solar companies instead of gas companies. Which perspective do you think is right? Let me know in the comments below. The interesting thing is that there are numbers that actually show when companies are high in ESG metrics, it actually makes them more likely to outperform the market. Are ESG companies good investments? This is a really interesting question because predicting what any kind of investment will do is really difficult. But there are some trends that we can look to for guidance. Over the last couple of years, we have seen an ESG awakening, and we know that companies that score well in ESG evaluations get bought by sustainable index funds and ETFs to the tune of trillions of dollars a year. At the close of 2022, ESG assets had almost doubled to $41 trillion when compared to $22.8 trillion in 2016. This means that a company with a high ESG score will be more expensive to buy than a comparable company with a low ESG score, all else being equal, because there is additional demand from a growing number of people wanting to invest in that clean company. As you can see in this graph, during the ESG awakening phase, the green company saw an increase in stock valuation. And yes, this isn't a perfect graph because not all non-ESG prices have fallen in real value over the last couple of years, but hopefully this shows the point that the valuation is higher for ESG companies than non-ESG companies. Now you might be thinking, wait, Kobe, that just means that the green stocks are more valuable because there's a fad in the market for them right now, right? There's not any real value being created. And you would be right if the graph wasn't missing something important. When companies adopt ESG principles, the principles actually tend to improve their operations, not just the stock price. Let's just talk about this conceptually for a second. Whose employees will be more motivated to work harder / be better employees? Walmart, who on average pays its employees $13.21 an hour, or Costco, who on average pays its employees $17.69 an hour. If you've been to both stores, you probably agree that Costco employees seem happier and are usually a bit more helpful. Another example is that Volkswagen wouldn't have had to pay billions of dollars in fines and had huge reputational damage if it would have just adhered to ESG principles and not cheated emissions tests, which led to the Dieselgate scandal. And finally, FedEx, which aims to convert its entire 86,000 vehicle fleet to electric or hybrid vehicles. Imagine how much lower their operating costs will be once they don't have to pay for all of that gasoline. And yes, they'll still have to pay for electricity, but you can generate electricity a lot cheaper than you can buy gas. Now, if you're still thinking, I don't know, Kobe, are there any hard numbers to this? Well, yeah. According to a study by More Global, since 2019, profits for ESG adopters have risen 3 times faster than those not adopting ESG principles. In addition, sales for ESG-focused companies increased twice as much as non-ESG companies. And 83% of companies that invested in ESG reported improved customer retention. And finally, 84% reported that ESG practices actually improved their ability to attract external investment. On top of all of this, companies with high ESG ratings have an easier time hiring talent, even with the labor shortages of 2020 and 2021. Their headcount increased 11% over the last 3 years, which is nearly twice the headcount growth of the laggards in this space at 6.5%. On top of this, a study at Harvard found that companies with ESG performance in the top quintile of companies had higher average return on equity than the bottom quintile in ESG. Low ESG companies are just not as efficient at using their assets to generate revenue. And high ESG companies have a higher rate of economic value added than their low ESG brothers. And as you can see in this graph, both top ESG and bottom ESG firms have similar rates of being leveraged. So the increase in performance we just talked about is not due to a higher leverage in high ESG companies. In addition, according to Harvard's study, you have about a 47.8% chance of choosing a stock that outperforms the market for a given time frame. But that chance increases by 7.7% to 55.5% when the stocks are screened for ESG performance. So yes, even if you buy in at the inflated greenium price, stocks that are labeled as ESG look like they have a higher chance of outperforming the general market than comparable non-ESG brands. So, we should just pile all of our money into strong ESG companies, right? Yeah, not so fast. Although ESG companies do show a statistical likelihood of outperforming the market, there is the possibility that a low ESG company will change its ways and start investing in ESG. If you were holding stock when this change occurred, you would expect to benefit from the greenium increase in addition to the future benefits of ESG operational efficiencies. Now, this would be the dream scenario, right? Well, this is exactly what activist investors do. When you hear about the activist investors buying up significant portions of a company to give themselves seats on the board so they can push green, social, or management changes, this is what they're seeking to do. These big investors know that yes, they will make the world a better place or they'll help the environment to be better, but by doing so, they will also make a lot of money for themselves. Unfortunately, doing this is out of the realm of possibilities for you or me, but there are some great ways to use this information to make money. But before we talk about that, I want to answer the what is stopping companies from placing a priority on ESG question. According to McKinsey & Company, there are 4 main reasons companies are hesitant to invest in ESG. First, ESG is not desirable because it is seen as a distraction. Perhaps the most prominent objection to ESG has been that it gets in the way of what critics say is the core of what businesses are supposed to do, and that's make money. They follow after Milton Friedman's statement of, quote, make as much money as possible while conforming to the basic rules of society, end quote. They look at ESG like a sideshow, a public relations move, or even a means to cash in on the beliefs and values of customers, investors, or employees. ESG is something good for the brand, but not foundational to a company's strategy. It is additive and occasional, but not strategic. But that same Milton Friedman, who opponents of ESG quote, also said, quote, it may well be in the long-run interest of a corporation that is a major employer in a small community to devote resources to providing amenities to the community or to improving its government. That may make it easier to attract desirable employees, it may reduce the wage bill, or lessen losses from pilferage and sabotage, or have other worthwhile effects, end quote. So it's not like one of the greatest economists ever was fully against ESG. But this point is a common detriment to ESG expansion. 2. ESG is not feasible because it is intrinsically too difficult. Executives see striking the balance required to implement ESG in a way that makes everyone happy as just too hard. When solving for a financial return, the objective is pretty clear: maximize value for the corporation and its shareholders. But ESG isn't always so clear. Solving for multiple stakeholders can be filled with trade-offs, and you likely can't make substantial changes without making somebody upset. The optimal choice of what to do is not always clear. The process of becoming a more equitable and sustainable company is not just like flipping on a light switch. There are many complex problems management has to face and address on top of their normal duties as leaders of their firm. Third, ESG is often difficult to measure. A third objection is that ESG, particularly as reflected in ESG scores, are hard to measure or cannot be accurately measured. Some critics argue that aggregate ESG scores have little meaning at all. As we talked about earlier, with so many different rating agencies with different rating methodologies, the results are not very consistent. For example, GRI, or the Global Reporting Initiative, and SASB, or the Sustainability Accounting Standards Board, can measure the same thing very differently. GRI measures employee training by dollar amount spent on training, whereas SASB measures training by the number of hours you put into training. You can see that these two different measurements could lead to very different results. Contrast this to college rankings, where there is a dominant player in the industry. Most people default to the US News college rankings to see what schools are best, but there is not one dominant player in the ESG rating space that executives can look to as a scoreboard, like people do for the US News college reports. And it's not even like all the scoreboards are similar. Each company's ESG score differs a lot depending on which company is rating it. For perspective, while credit scores by S&P and Moody's both correlate at 99%, ESG scores across 6 of the most prominent ESG rating providers correlate only on average about 54% of the time. Until there is more uniformity of ratings, many leaders just won't care. Fourth, even when ESG can be measured, there is no meaningful relationship with financial performance. The fourth objection to ESG is that positive correlations with outperformance can be explained by other factors and are not causative. This is an old-fashioned belief that is beginning to change, but the reality is that isolating and assigning causative value to most things in business is extremely difficult. In other words, empirically proving that X ESG initiative led to Y dollars in increased profit is very difficult. Changing people's minds takes time. Think about the NFL and how people who are getting paid millions of dollars argue over whether or not to go for it on 4th down. There's statistical evidence that if you're on 4th and 1 or 4th and 2 or whatever the number is, you should either go for it or you shouldn't go for it. Yet people still debate the topic, and football, although complex, is a lot less complex of an environment than the business world as a whole. Sometimes change just takes a little while. How you can use this information to make money. Now, this is all great, but what good are all these numbers in this video if you can't use them to make you more money? So here are some ideas of ways to benefit from this information. First, the fact that you now know that companies that make ESG a priority tend to outperform the market will likely help you make profitable picks as you analyze different companies to invest in. Second, know that you can still invest in ESG companies even without using an ESG fund. ESG funds have much higher expense ratios than other funds. They can charge up to 30 times the expense ratio of top S&P 500 index funds. So if you want to still gain access to the potential market-beating opportunity but not pay the high fees, you could buy the 10 largest positions in the index fund, and assuming you take a passive approach, this shouldn't be that much of an extra hassle. Third, actually vote when those stakeholder votes come up. When you own a stock in a company, oftentimes you get to vote on certain initiatives. If you vote for ESG opportunities when they come up, you could help a brown company become a green company and reap the benefits of that in its stock value. And fourth, in your own workplace, you can encourage ESG adoption. Remember, ESG principles aren't just good for the stock price of the company, they're good for the company as a whole. Some ways you can help your company adopt ESG principles are by reducing energy expenses by installing solar, decreasing turnover by improving the way people are treated at work, or making employees happier by giving them benefits like work from home flexibility. Even if you're not in leadership at your firm, you can still make a big impact by helping people of diverse backgrounds feel more accepted. I know you can make a big impact of your firm no matter what level you're at. But what do you guys think of these money maximizing ideas? Can you guys think of any others? If you have a good one, be sure to share it in the comments below. But to summarize, companies that adopt ESG principles tend to outperform the general market. But make sure you research each one to make sure they align with your personal values before investing. Also, since you guys have watched all the way to the end of the video, you probably like videos like this. So I'd ask you to consider subscribing. I think you'll really like the videos. Thank you guys again for watching, and I'll see you next time.